Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. Today, we're diving deep into a collection of really fascinating recent financial news.
Oh, yeah.
You've shared articles covering everything from the risks of SPAC investments to global market reactions to tariffs to the future of crypto beyond Bitcoin,
Mhm.
changes in European telecom, and even the inner workings of the currency market.
Wow, that's a lot to unpack.
It is.
Yeah.
It is. Our mission today is to synthesize these seemingly disparate headlines and pull out the key insights you need to understand what's really going on.
Sounds like a plan. Let's dive in.
Okay, let's start with the world of SPACs. We've got this piece from MarketWatch titled 23andMe's failure shows how risky it can be to invest in a SPAC.
Oh, yeah, I saw that one. It really highlights some of the potential pitfalls.
Yeah, it focuses on the bankruptcy of 23andMe as a prime example of the risks that can come with investing in companies that went public by merging with a SPAC, a special purpose acquisition company.
Right, and the article really digs into that whole process, how it allows companies to kind of bypass some of the more rigorous investigations and disclosures involved in a traditional IPO.
Exactly. It's like a shortcut to the stock market.
Yeah, essentially a private company merges with this already publicly listed blank check company that's specifically set up to find and acquire a business.
Right. And because there isn't as much scrutiny as you typically see with IPOs, SPACs initially became attractive to, higher risk, often early stage companies.
Fewer hurdles, less stringent disclosure rules probably sounded pretty good to them at the time.
Absolutely. The article points out how 23andMe, the genetics testing company, merged with Richard Branson's Spadamy back in 2021.
Oh, wow, that was a big deal, wasn't it?
Yeah, a huge deal. It was valued at $3.5 billion.
Yep.
And they had over $900 million in cash right after the merger.
Yeah, but then the MarketWatch piece points out that just months after that, their cash reserves were shrinking rapidly.
Right. It really highlights the substantial costs associated with the whole SPAC structure.
One big factor, the sponsors, in this case Branson's team, typically receive around 20% of the company's shares just for orchestrating the deal.
20%, that's a lot.
It is. And then there's the research from Michael Klausner, a professor at Stanford who's really dug into SPACs.
I read some of his work. It's fascinating.
Yeah, he talks about their dilutive qualities and how the cash that actually ends up in the operating company's hands can be significantly less than what they would have raised through a traditional IPO, even after accounting for those underwriter fees.
It's eye-opening, isn't it? The article goes on to say that a lot of these de-SPAC companies are essentially still operating like startups.
Right, and they burn through cash, especially if their revenue growth isn't keeping pace.
Like with 23andMe, their initial sales from those DNA test kits eventually plateaued.
Makes sense. Most people only buy one or maybe a few in their lifetime.
And their efforts to expand into telehealth and drug development didn't generate enough revenue quickly enough.
So their revenue was actually down compared to the periods right after the SPAC merger.
Even with all that initial cash, their reserves took a major hit. And for investors who bought in after the hype, it's been a rough ride.
Yeah, the stock is trading for well under $1 now. They're even considering selling their database of customer genetic data.
Wow, that's a big move. It really makes you think about their future.
It does. And it also highlights the question of long-term sustainability for companies that go public this way.
Right. The article reminds us that SPACs saw a surge in popularity after the pandemic lockdowns, despite warnings from experts.
And even as the SEC implemented stricter regulations to try to make the process more like traditional IPOs.
Yet many of these de-SPAC companies are still struggling.
23andMe is not alone either.
No, the article cites data from DebtWire, which tracks a staggering 40 bankruptcies among SPAC companies since 2022.
40, that's a lot.
It is. John Bringardner from DebtWire is quoted as saying, "The frenzy of 2021 led to a lot of troubled names that frankly never should have received this kind of financing."
Wow. So essentially some companies that probably shouldn't have gone public got easy access through SPACs.
Exactly. The article then lists some other well-known troubled de-SPACs: WeWork, Bird Global, Lordstown Motors.
Those are some big names.
They've all gone through Chapter 11 restructurings. Then you have companies like Babylon Health and Electric Last Mile Solutions that went into Chapter 7 liquidation.
So they had to sell off assets and cease operations.
Yeah, it's a concerning trend.
It does make you wonder if the initial enthusiasm for SPACs kind of overlooked some fundamental weaknesses.
Absolutely. And then there's Oklo Inc., a nuclear energy company that went public via SPAC.
I remember reading about them. There was some buzz around them initially.
Right. Major tech companies were expressing interest in nuclear power and their stock soared.
But then it took a major plunge.
It did, and they're still in the pre-revenue stage.
It really shows the speculative nature of some SPAC investments. Future potential can overshadow current realities.
For sure. And speaking of speculation, the article reminds us about the ticking clock for SPACs.
Right. They typically have 2 years to find an acquisition target.
If they don't, they have to return the money to investors.
And we're seeing really high redemption rates lately, meaning investors are choosing to get their money back.
Professor Klausner's research shows that only a tiny percentage of SPACs that merged between 2019 and 2022 were trading above their initial listing price as of January.
So what does all this mean for the average investor?
It really underscores the heightened risks of these less scrutinized public offerings, especially in a volatile market.
It's a cautionary tale about doing your research and not getting swept up in the hype.
Absolutely. Now let's shift gears to the global market. We've got these articles, Asia Markets Live, Stocks Fall from CNBC, and European Markets Live updates, stock moves, tariff news, and data, also from CNBC.
Yeah, those headlines pretty much sum it up. Markets are feeling the pressure, especially with those tariffs looming.
Right. The Asia Markets Live piece details a pretty significant downturn across Asia Pacific.
Japan's Nikkei 225 actually entered correction territory, meaning it's fallen a lot from its recent peak.
We also saw losses in South Korea's Kospi and Kosdaq and Australia's S&P SX 200.
It signals a negative shift in investor sentiment.
Definitely. And mainland China's CSI 300 and Hong Kong's Hang Seng Index also experienced declines.
Indian markets were closed for a holiday, so we didn't get to see their immediate reaction.
But the overall tone out of Asia was negative, and all this was before the tariffs even hit.
All right, and that uncertainty is having a knock-on effect on U.S. futures, too. This comes after a big sell-off on Friday.
Which was linked to anxieties about trade policy and inflation.
Yeah, we saw major U.S. indices, the Dow, the S&P 500, the NASDAQ, all take a hit. And tech companies decline too.
So looking at specifics in Asia, the article highlights some companies that saw the biggest drops: Renesas, Electronics, SoftBank, and Japan.
And Hong Kong's Hang Seng Tech Index took a beating. There's even mention of CK Hutchison shares falling because of a port deal in Panama.
So it seems like a mix of factors, not just tariffs are weighing on confidence.
What's interesting is that amidst all this, Thailand's stock market and payment services were operating normally despite a powerful earthquake.
Wow, that's resilient.
It shows how localized some impacts can be.
And the CNBC article points out that spot gold hit a record high as investors sought a safe haven.
Makes sense. That's a classic reaction during times of uncertainty.
Now moving to Europe, the European Markets Live updates piece from CNBC shows the same negative sentiment. Markets opened sharply lower on Monday.
Investors are bracing for those tariffs to take effect.
The Pan-European Stock 600 index was down, with Germany's DAX leading the losses.
European investors are definitely concerned about the potential consequences for their economies.
Especially that expected 25% tariff on all cars not made in the U.S.
Right. The article points out the impact this is having on the European stocks, automobiles, and parts index.
And major car manufacturers like Volkswagen, Mercedes-Benz, Renault all saw their shares decline.
It's a direct threat to a major European industry.
And the Trump administration is calling April 2nd Liberation Day. They're talking about reciprocal tariffs.
And the Wall Street Journal reported that Trump was pushing for an even more aggressive stance on tariffs.
In an interview, he said he couldn't care less if foreign automakers raise prices because of the tariffs.
So he's standing firm on his trade policy.
But it's not all doom and gloom in Europe. The CNBC article mentions a rally in British assets after a call between Prime Minister Starmer and Trump.
About a potential UK-US economic deal.
Right. The prospect of that special trade arrangement is being viewed favorably.
We also saw a surge in Aston Martin's share price, driven by funding from its chairman.
Showing that even in a down market, company-specific news can boost stocks.
And there was a takeover bid for a Swedish financial services firm called Fortnox, indicating that M&A activity is still happening.
So the global market reaction is directly tied to the uncertainty and potential economic impact of these tariffs.
It really highlights how interconnected global markets are.
Now let's dive into crypto specifically, looking beyond Bitcoin. We've got this Bloomberg article, Crypto's Trumpian Embrace is leaving Bitcoin's big rival behind.
It seems like Ethereum is facing some headwinds, despite its early promise.
The article points to several issues: developer departures, dissatisfaction among early adopters, and the fact that Ether has been underperforming compared to Bitcoin and other cryptos.
There's definitely increased pressure on Ethereum's founder, Vitalik Buterin, with some questioning his leadership.
And the article mentions a significant drop in the value of Ether this year. It seems like Ethereum's decentralized nature, which was once a strength, might now be a liability.
especially as much of the crypto industry seems to be aligning itself with Trump.
Right. The article highlights a decline in active developers working on Ethereum, while Solana has seen growth in its developer community.
That can be a critical indicator of long-term viability.
Standard Chartered analysts even reduced their price forecast for Ether, citing an identity crisis for the platform.
Uncertainty about its future direction.
Buterin acknowledges that some of Ethereum's initial promises haven't been fully realized and is emphasizing long-term sustainable value.
He's focused on real-world use cases and adoption.
But there's a contrast between his approach and the crypto industry's embrace of Trump. We're seeing donations and support from many in the crypto space.
Buterin has criticized politician coins, like the Trump meme coin, suggesting they could be used for bribery.
And Ethereum was absent from a recent White House crypto summit. It seems their decentralized structure makes political engagement difficult.
The article also mentions the slower-than-expected progress of DeFi, decentralized finance, which was built on Ethereum.
And while there's been some Web3 growth, the real excitement seems to be around meme coins and apps on platforms like Solana.
Solana has faster transaction times and lower fees.
The data shows Solana actually had more active addresses and transactions than Ethereum in February.
There are also criticisms about the Ethereum Foundation being slow with upgrades.
And some argue that their focus on Layer 2 blockchains has taken activity away from the main Ethereum network.
So it's a rapidly evolving landscape where Ethereum's facing competition and political challenges.
Let's move on to European telecom. We have this Bloomberg piece. Post Italian now runs Telecom Italia, and deals could follow.
Big changes in the Italian telecom market.
The article explains how the Italian Postal Service has become the largest shareholder in Telecom Italia.
They acquired a majority stake from Vivendi.
This is expected to lead to consolidation in the Italian telecom market.
It's interesting to see the Italian government taking a more active role.
The article suggests this could be good for Telecom Italia, which is considered a national asset.
Telecom Italia has struggled with debt and a competitive market.
Post Italian's involvement could revitalize it and maybe lead to M&A activity with Iliad SA.
It's part of a trend of governments taking a more active role in key industries.
Now let's talk about pre-hedging. This Bloomberg article, pre-hedging spurs face-off between banks and investors over global rules.
It's about regulators trying to clarify the rules around this trading practice.
The article explains pre-hedging as dealers using client trade information to place their own trades beforehand.
Banks say it's risk management, but investors worry about market abuse.
Global regulators at IOSCO are working on new rules.
There's a divide with banks in favor and asset managers concerned about front-running.
The goal is to define legitimate pre-hedging versus illicit front-running.
Pre-hedging in competitive RFQs is particularly controversial.
Banks defend it, but some want a ban.
There have been huge fines for front-running in the past.
IOSCO says pre-hedging should only be for genuine risk management.
And data from France shows it's a frequent subject of suspicious activity reports.
It's a debate about transparency and fairness in financial markets.
New regulations could change how firms manage risk and interact with clients.
Staying on regulation, we have this from MarketWatch. The CFPB was on the brink of shutdown. Here's what a judge's temporary stay means for borrowers and
The Consumer Financial Protection Bureau got a temporary reprieve.
a federal judge issued an injunction to prevent its shutdown.
It means rehires and continued consumer protection functions.
The Trump administration wanted to reduce the CFPB's role.
They cited concerns about overreach.
The injunction is temporary. The CFPB's future depends on legislation.
It highlights the political debate about the role of regulatory agencies.
Now let's look at the currency market. This Bloomberg article, Wall Street fears liquidity problems creeping back into currency market.
Concerns about a liquidity mirage.
Major players like Citigroup and Deutsche Bank are worried.
They're seeing signs of fragility, like trade rejections and bid-ask spread volatility.
The August 5th blow-up in dollar-yen is a prime example of how quickly things can change.
More trading platforms, but declining volumes on interdealer markets.
Banks are internalizing more client orders, and regulation has reduced risk appetite.
Non-bank market makers are playing a bigger role, but might not be able to handle big shocks.
Concerns about fill rates and intraday liquidity variability.
Market supervisors like the New York Fed are monitoring the situation.
Some research suggests the FX market is resilient, but others point to yen illiquidity.
It's an ongoing debate about market structure and the need for transparency.
Okay, let's turn to the oil market. This MarketWatch article, OPEC Plus is boosting output in April. Here's what that could mean for oil prices.
OPEC Plus is unwinding production cuts, But there are other factors at play.
Yeah, like sanctions on Iran and Russia, potential sanctions on Venezuela, and worries about tariff-induced recession.
Oil prices recovered in March, ending near February levels.
OPEC Plus says their decision is adaptable.
Energy expert Anas El-Haji points out the volatility caused by Trump's policies.
The U.S. plans to refill its strategic petroleum reserve, which could support prices.
And there's the threat of secondary tariffs on countries buying Venezuelan oil.
Analysts are divided on the direction of prices, with some seeing limited downside due to supply risks and others remaining bearish.
OPEC Plus has a timeline for the cuts and compensation cuts for overproduction, but compliance is always a question.
It's a complex situation with OPEC Plus decisions, U.S. foreign policy, and tariffs all influencing the oil market.
Definitely a lot to watch.
Now let's talk about Larry Fink and private investments. This Bloomberg article, Larry Fink vows to unlock private investments for the masses.
This could change how people invest.
BlackRock's CEO wants to open up private markets to everyday investors.
He's concerned about twin inverted economies and wants broader participation and growth.
BlackRock is investing heavily in private markets.
Fink suggests the 60-40 portfolio might be outdated and proposes a 50-30-20 allocation with 20% in private assets.
Like real estate, private credit infrastructure.
They want to use data and tech to make valuations more transparent.
It could offer diversification and better returns.
He also talked about the dollar, energy sources, and AI's impact on jobs.
It's a trend to watch for sure.
It could be a major shift in investing.
Finally, let's look at this Bloomberg article. Low correlations among U.S. stocks. Warren Coast isn't clear to buy.
It's a cautionary sign, despite the recent sell-off.
Low correlation among S&P 500 stocks suggests a lack of capitulation.
Strategist Jim Paulson says S&P 500 returns are lower during periods of low correlation.
We had a correction, but the VIX hasn't spiked.
And daily declines have been measured.
Sector divergence is driving the low correlations.
There have been outflows from stock funds, and bearish sentiment is up.
But it might not be time to buy aggressively yet.
Low correlation suggests caution is warranted.
We'll see you all tomorrow morning with new headlines from major financial magazines.